back to another video in our fundamental analysis series. We're almost at the finish line. This is our second last video. And if you've been following along, you must have a solid understanding regarding how to evaluate a company beyond just its stock price. So far, we've covered what fundamental analysis actually is, how to read an annual report, and how to understand the three core financial statements: the P&L statement, the balance sheet, and the cash flow statement. But here's the thing, watching these videos is just the beginning. To really build your skills as a fundamental analyst, you need to download that annual report and analyze the numbers yourself. That's the only way the real learning can happen. You see, these numbers aren't just statistics, they tell a story. I know, it sounds a little bit cliche, but I'll tell you why. But before getting to that, make sure to hit that like button and subscribe to our YouTube channel so you don't miss out on any updates from us. Okay, so let's break this down. Each financial statement is important, but the real power comes when you connect them together and see what's really going on inside the hood. But how to connect them together? Let's take a look at a few examples. You check the P&L statement and the company shows strong profits, so great news. Or is it really? Because the cash flow statement shows a negative cash flow from the operating activities. So what does that mean? What about the profits? The profits are still there, but it might mean that the profits didn't come from the company's core business. Instead, it came from hefty loans or selling of company assets. Red flag. Another company shows high debt on the balance sheet. So does that mean the company is doomed? Maybe. But then you take a look at the cash flow statement and you find out that the cash was actually being used for investing activities, like buying new machinery, properties, or even acquiring other businesses. Hence, they might be taking on debt to grow in the long term. Green flag if managed properly. So now does investing always mean a good thing? Say if a company is heavily investing and acquiring assets left and right, you might think, oh wow, they're expanding fast. But then you look at the P&L statement and there are barely any profits at all. Now growth is great, but if it's not profitable and unless if a company has a solid game plan, the empire might go down. These are just a few questions, and see how asking the right questions can make all the difference. Where is the money coming from? Are the profits sustainable? Is the company relying too much on debt? Are they reinvesting profits wisely? Fundamental analysis is like putting together a jigsaw puzzle. Each financial statement is a piece, and you'll only get the full picture after combining them all together. Now, don't get scared, I get it. Digging through a bunch of sheets to make sense of numbers is not everyone's cup of tea. And even for those who can, time constraints become the real challenge. So, what's the solution? Well, what if there was some kind of formula in which you could input these numbers to get a result? And this result could show you clearly whether or not to invest in a stock? That's exactly what financial ratios do. They help you break down all these numbers into simple, understandable indicators that show you a company's financial health, its efficiency and profitability, its level of risk, and ultimately, whether the stock is a good investment or not. In our next video, we'll introduce you to the most important financial ratios and show you how to use these to cut through the noise and focus on what really matters. So stay tuned, and I'll see you guys next time.
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.